Well, this is the final news roundup of 2025, and honestly, I wasn't expecting anything dramatic during a holiday-shortened week. But Nvidia changed that overnight. While most people were unplugged for Christmas, Nvidia quietly made the biggest move in its 32-year history, announcing a $20 billion deal involving the AI chip startup Groq. And here's the twist, Nvidia isn't even calling it an acquisition. That single detail might matter more than the price tag itself. So let's break down what really happened and why it could reshape the future of AI. Groq builds a very different kind of AI chip. Instead of GPS, they focus on LPS, or language processing units. If you've ever used Chat or any AI chatbot and noticed a delay before the response appears, that's inference happening in real time. Nvidia's GPS are incredibly powerful, but they were originally designed for gaming and large-scale parallel computing, not specifically for text generation. Groq designed their chips from the ground up for inference, meaning they can generate responses significantly faster while using far less energy in some cases. Performance gains are reported to be nearly 10 times faster at a fraction of the power cost. Behind Groq is Jonathan Ross, a name that matters a lot in this story. Before founding Groq, Ross worked at Google and helped create Google's TPU, the Tensor Processing Unit. TPUs are one of the few technologies that genuinely threaten Nvidia's dominance in AI hardware. That background becomes critical once you look at what Google did just weeks before this deal was announced. Google recently unveiled its 7th-generation TPU, called Ironwood. Alongside the release of Gemini 3, what shook investors wasn't just the model's performance, but the fact that Gemini 3 was trained entirely on Google's own hardware. No Nvidia chips were involved at all for the first time. The market saw a clear example that world-class AI could be built without Nvidia at the center. Google's stock reacted positively, Nvidia's dipped, and suddenly Nvidia's position didn't look quite as untouchable as it once did. Nvidia's response was fast and strategic. Rather than competing head-to-head, they went after the architect behind Google's alternative. But instead of buying Groq outright, Nvidia structured the deal as a non-exclusive licensing agreement. They're paying $20 billion to license Groq's technology and bring over Jonathan Ross, Groq's president, and several key engineers. On paper, Groq continues to exist as an independent company under new leadership, with its cloud business still operating. So why go through all that complexity instead of just acquiring the company? The answer is regulation. In 2022, Nvidia attempted to acquire ARM for $40 billion, and regulators shut it down. With Nvidia already controlling an overwhelming share of the AI chip market, a direct acquisition of Groq would almost certainly trigger intense antitrust scrutiny by labeling this as a licensing deal. Instead of a takeover, Nvidia sidesteps that entire process. One analyst summed it up perfectly by saying this structure preserves the illusion of competition. What's interesting is that Nvidia isn't alone in using this strategy. Google, Microsoft, and Amazon have all executed similar deals over the past year. These arrangements allow big tech companies to absorb talent and technology without formally acquiring competitors. But there's a darker side to this playbook, especially for employees in a traditional acquisition. Employee stock options usually convert into cash or equity in the acquiring company. Early employees who accepted lower salaries often walk away with life-changing payouts. In licensing deals like this, that doesn't necessarily happen. Research into similar transactions suggests that employees with unvested stock options often receive nothing. Founders and executives get massive compensation packages. Investors benefit from licensing fees, and the rank-and-file employees who helped build the company may be left behind inside what's essentially a shell of the original startup. This makes the celebration around the deal feel incomplete. Yes, it's a win for Nvidia. Yes, Groq's investors are seeing huge returns. But there is a growing pattern where innovation is rewarded at the top while the broader workforce absorbs the downside. What makes this deal even more fascinating is how Jonathan Ross used to talk about Nvidia. He never framed Groq as a competitor. Instead, he consistently described the company as complementary to Nvidia. His argument was simple: Nvidia dominates AI training, while Groq excels at inference. Faster inference leads to more AI usage, which ultimately increases demand for training. From that perspective, Groq wasn't threatening Nvidia at all, and now, that philosophy has effectively been absorbed into Nvidia's strategy. For Nvidia, this move is both defensive and offensive. Defensively, it neutralizes a future threat by bringing in one of the most experienced chip architects in the world. Offensively, it strengthens Nvidia's position in inference, which is where the AI industry is heading as models move from research labs into everyday products used by millions of people. For regulators, this deal raises a serious question. If licensing structures can be used to avoid antitrust oversight while achieving the same end result as an acquisition, then what role do antitrust laws actually play going forward? And for startups, the message is increasingly clear. Competing with Nvidia long-term may be less realistic than building something valuable enough to be absorbed. Nvidia now sits on tens of billions in cash and can write checks that quietly erase competition before it becomes a real threat. The real question isn't whether this deal is legal. It is. The question is whether this is the kind of AI ecosystem we want to build. If you found this breakdown useful and want more clear, no hype explanations of what's actually happening in AI and finance, make sure to like the video and subscribe to the channel. I'll be back in 2026 with more deep dives like this, and I'll make sure you stay ahead of the biggest shifts shaping the future.